The U.S. government has a legal limit on how much it can borrow, known as the debt ceiling. This limit has been reached, and Congress needs to raise it or risk defaulting on its obligations. A default would have serious consequences for the economy, especially for the agricultural sector. One of the main effects of a default would be a spike in borrowing costs for consumers and businesses. This is because lenders would demand higher interest rates to lend money to a risky borrower. Higher interest rates would make it harder for people to buy homes, cars, and other goods, reducing demand and slowing down economic growth. For farmers, higher borrowing costs would be especially damaging. Farming is a capital-intensive business that relies on credit to finance operations, such as buying seeds, equipment, and land. Farmers also face unpredictable risks from weather, pests, and market fluctuations. If interest rates go up, farmers would have to pay more to service their existing debts and face difficulties accessing new loans. According to the American Farm Bureau Federation, farm debt reached a record high of $434 billion in 2020. The average interest rate on farm loans was 4.6% in 2021. If the debt ceiling crisis leads to a default, these rates could rise significantly, putting more pressure on farmers' finances. A default could also affect the value of the US dollar and the prices of commodities. The US dollar is the world's reserve currency, meaning that many countries and businesses use it for international trade and investment. A default would undermine confidence in the dollar and cause it to depreciate against other currencies. This would make US exports cheaper but also make imports more expensive. For farmers, this could have mixed effects. On one hand, a weaker dollar could boost their competitiveness in foreign markets and increase their revenues from exports. On the other hand, a weaker dollar could also raise their costs of inputs, such as fertilizers, pesticides, and machinery, that are imported or priced in foreign currencies. Moreover, a default could trigger volatility in commodity markets, where many agricultural products are traded. Commodity prices are influenced by supply and demand factors as well as by expectations and sentiments of investors. A default could create uncertainty and panic in the markets, leading to sharp swings in prices. For farmers, this could mean more instability and unpredictability in their incomes. Depending on the direction and magnitude of price changes, some farmers could benefit while others could lose out. For example, if corn prices rise due to a weaker dollar or lower supply, corn growers could gain while livestock producers who use corn as feed could suffer. In summary, a default on U.S. debt could cause borrowing costs to spike for consumers and businesses, including farmers who rely on credit to finance their operations. It could also affect the value of the US dollar and the prices of commodities, creating winners and losers among different segments of the agricultural sector. The debt ceiling crisis is a looming threat to the U.S. economy and the federal government's ability to pay its bills. If Congress fails to raise the debt limit by June 1, the Treasury Department will run out of cash and borrowing authority, and could default on its obligations for the first time in history. This would have severe consequences for the country's credit rating, financial markets, and economic growth. One of the sectors that could be especially affected by a debt default is agriculture. Agriculture is a vital part of the U.S. economy, contributing about $1.1 trillion to the gross domestic product and supporting more than 22 million jobs in 2019. Agriculture also relies heavily on federal programs and policies that provide income support, crop insurance, conservation, trade promotion, research, and nutrition assistance. A debt default could jeopardize these programs and policies, and hurt farm income and profitability in several ways. First, a default could trigger higher interest rates across the economy, as investors demand higher premiums for lending to the U.S. government and other borrowers. Higher interest rates would increase the cost of borrowing for farmers, who rely on credit to finance their operations, buy land and equipment, and manage cash flow. According to the USDA, farm debt reached a record high of $434 billion in 2020, and interest expenses accounted for about 20% of total production expenses. Second, a default could cause lower commodity prices, as a result of reduced demand and economic activity both domestically and globally. Lower commodity prices would reduce farm income and cash receipts, which are already projected to decline by 8% in 2023. Lower commodity prices would also affect the value of crop insurance indemnities and payments under the price loss coverage and agriculture risk coverage programs, which are based on market prices. Third, a default could disrupt the implementation and funding of the Farm Bill, which is a critical piece of legislation that sets food and agriculture spending for the next decade. The Farm Bill is due for reauthorization by September 30, 2023, but the debt ceiling standoff has stalled the negotiations and progress on the bill. A default could also affect the availability of funds for existing Farm Bill programs, such as direct loans and loan guarantees, conservation programs, trade promotion programs, and nutrition assistance programs. These programs provide essential support and services to farmers and rural communities, especially during times of economic hardship and uncertainty. The impact of a debt default on agriculture would vary depending on the duration and severity of the crisis, but it would likely be more pronounced for small and medium-sized farms than for large farms. Small and medium-sized farms tend to have lower incomes, higher debt-to-asset ratios, less access to credit, and more dependence on federal programs than large farms. Therefore, they would be more vulnerable to higher interest rates, lower commodity prices, and reduced government support. In conclusion, a debt default could have serious negative effects on agriculture and food prices in the EU. By increasing the cost of borrowing, reducing farm income and cash receipts, and jeopardizing federal programs and policies that support the sector. These effects could be especially harmful for small and medium-sized farms, which are more exposed to financial risks and market fluctuations than large farms. To avoid these consequences, Congress should act swiftly to raise the debt ceiling and ensure that the EU government can meet its obligations. A disruption in federal payments and programs could affect food security, nutrition assistance, crop insurance, conservation, trade, and rural development in many ways. Here are some of the possible impacts: food security and nutrition assistance. The Supplemental Nutrition Assistance Program, SNAP, also known as food stamps, is the largest food assistance program in the country. It supports nearly 42 million Americans who struggle to afford enough food. SNAP is funded by the Farm Bill, which is estimated to cost more than $709 billion over the next 5 years. However, if Congress fails to raise the debt ceiling and the government defaults on its obligations, SNAP could face severe cuts or delays in payments. This could leave millions of low-income families without adequate food and nutrition. Moreover, other food assistance programs such as school meals, WIC, and food banks could also be affected by a debt crisis. Crop insurance. Crop insurance is a vital risk management tool for farmers who face unpredictable weather, pests, diseases, and market fluctuations. The Farm Bill provides subsidies for crop insurance premiums and covers part of the losses incurred by farmers when disasters strike. However, a debt default could disrupt the payments to crop insurance companies and farmers, putting them at financial risk. Additionally, a debt crisis could increase interest rates and reduce credit availability for farmers who rely on loans to finance their operations. Conservation. Conservation programs help farmers protect and enhance natural resources such as soil, water, wildlife, and biodiversity. The Farm Bill allocates funds for various conservation initiatives such as the Conservation Reserve Program, the Environmental Quality Incentives Program, and the Conservation Stewardship Program. These programs provide incentives for farmers to adopt sustainable practices such as cover crops, no-till farming, buffer strips, and wetland restoration. However, a debt default could jeopardize the funding and implementation of these programs, undermining the environmental benefits they provide. Trade. Trade is an important source of income and market access for you. Farmers who export about 20% of their agricultural production. The Farm Bill supports trade programs such as the Market Access Program, the Foreign Market Development Program, and the Food for Peace Program. These programs help promote agricultural products abroad, assist developing countries with food aid, and address trade barriers and disputes. However, a debt default could damage the reputation and credibility of the EU as a reliable trading partner, leading to reduced exports and increased trade conflicts. Rural development programs aim to improve the quality of life and economic opportunities for rural communities. The Farm Bill provides funds for various rural development initiatives such as broadband access, water and wastewater systems, renewable energy, housing, healthcare, and business development. These programs help create jobs, reduce poverty, and enhance rural infrastructure and services. However, a debt default could hamper the delivery and effectiveness of these programs, worsening the challenges faced by rural America.